Hi, my name is Bara Atinora binti Muhammad Lani, with matric number 1192418.
My name is Fatina Biha binti Zainuddin. My matrix number 1192406.
Hi everyone, my name is Hadira binti Aziz. My matric number is 1190969.
Assalamualaikum warahmatullahi wabarakatuh. I am Farah Najwa binti Muhammad Nazri. My matric number is 1192412.
Hi, we are the representative of our financial department. I'm Bari Atun and my teammate are Farah, Hadira and Fatih.
I'm Hadira.
I am Farah.
I am Fatih.
Is everyone ready for the presentation?
Yes!
Yes.
For today, we are going to discuss on financial performance of two companies, which is Aeon and SDIY. These two companies will be taken into consideration for our company's investment. So each member are going to talk and discuss about each categories. And I, Bari Atun, will talk on leverage ratio and SWOT analysis. Hadra will give introduction for Aeon and talk about efficiency ratio. Farah will give introduction for Mr. DIY and talk about liquidity ratio. Fatih will talk about profitability ratio and will give some conclusion. So let me start with the introduction for both companies.
As for Mr. DIY, it was founded in 2005 by Tan Yulian. They established their first store on Jalan Tunku Abdul Rahman, and it has since grown to the largest home improvement retailer in the region, with more than 700 stores throughout Malaysia and 4 in Brunei. Mr. DIY offers a large selection of over 16,000 products, and most of their stores are approximately 10,000 square feet per store, allowing for a pleasant and healthy family shopping experience. Another feature that contributes to their appeal is their famous slogan, "Always Low Price." After entering the market in 2010, the company began to develop rapidly in the mall, marks a new trend for the company. Head into the Malaysian mall, will it be finding hard not to spot a Mr. DIY?
Next, for the background of Aeon, Aeon Company Malaysian Berhad was established on 15 September 1984 in response to the Malaysian government's invitation to Aeon Japan. Besides supermarkets and convenience store operations, Aeon also provide specialty store operation and shopping center development, credit card business and services. Aeon's activities are always guided by its unchanging customer-first philosophy.
Profitability ratio, gross profit margin. It is percentage of net sales of company. It is shows the amount of profit made before minus the deducting sales, general and administrative costs. It is used to compare company business model with its competitors. If it is fluctuates, it means pure management practice or inferior product, and if it is get higher, it can make reasonable profit on sales as long as it overhead costs in control. Gross profit margin formula is gross profit divided by revenue. Product rule with 100. Gross profit comes from the formula of net sales minus cost of goods sold. Net profit margin before tax. It is used to measure how much the net income of company earn as a percentage of revenue received. It is also an indicator of efficiency of a company before deduct the tax. Okay, based on this calculation, we get that Mr. DIY is higher than the Aeon. It means higher pre-tax profit margin means healthy company with an efficient business and power of pricing. It is used to compare competing companies as well as those with significant difference in size and scale in the same industry. The formula for net profit margin before tax is profit before tax divided by revenue times with 100. Net profit margin after tax. It is used to compare companies with the same industry. Margin analysis is function to find the best investment. Based on these calculations, we know that Mr. DIY is higher than the Aeon. When Net profit margin declining over time. It is because the decreasing of sales. Why sales decrease? It is because to the pure customer experience to inadequate expense management.
Let's move on to the liquidity ratio. Liquidity ratio measures the extent to which a firm has adequate cash flows or liquid assets to meet the short term of liabilities of the firm. It consists of current ratio, asset test ratio, or also known as quick ratio, inventory turnover ratio, account receivable, and payable turnover ratio. I have a slide here that shows the comparison of current ratio and quick ratio for both companies. To calculate both ratio, we use the formula as shown in this slide. As for the current ratio, the comparison specifies that Mr. DIY's liquid assets are 3.41 times sufficient to pay its short-term debt. Same goes with quick ratio. Mr. DIY are higher than Aeon. This indicates that Mr. DIY is more financially stable and considered healthy, as their quick ratio is greater than 1. Next, as you can see in this slide, we apply this formula to calculate the inventory turnover ratio and stock turnover days for both companies. Taking into consideration of their inventory turnover ratio and stock turnover days, Mr. DIY is again ahead of the field at converting inventory into sales, which shows that it takes an average of 138 days to sell inventory items, and it needs to be updated 2.64 times during the financial year. In contrast with Aeon needs 398 days to clear the inventory and restock it 0.92 times during the period. As for account receivable turnover ratio and days, we measure the ratios by using this formula. In this context, Aeon is better at collecting and receivable accounts. They roll 91.33 times a year, and it takes an average of 4 days to recover the amount due from their trade debtors. Sorted by Mr. DIY, turn 18.68 times and recovered in an average of 20 days. In terms of account payables turnover ratio, it measures how quick companies pay creditors and suppliers that have expanded credit lines. The quicker a company pays its creditors, the better. In this case, Mr. DIY's situation is better. It takes an average of 70 days to pay the creditors and repeated 22.11 times in a fiscal year. Meanwhile, Aeon repeats 0.52 times per year, and it takes an average of 685 days in the fiscal year to pay their creditors. To measure the ratios and average of the days, we use the same formula as shown in the slide.
So now we move on to leverage ratio, which is include debt ratio and interest cover ratio. Debt ratio, by using total liabilities over total asset, we identify that 74% of Aeon total asset is financed using debt, while 81% of Mr. DIY total asset is financed using debt. So from here, we knew that choosing Mr. DIY as our investment company, we need to cope with a higher risk rather than Aeon. For interest cover ratio, we identify that Aeon has earning before tax and interest covers up to 2.25 times its interest expense, while Mr. DIY has earning before interest and tax covers up 3.64 times its interest expense. So from here, we know that Mr. DIY have a higher capability in meet their interest obligation from operating earning than Aeon.
Okay, now let's proceed to efficiency ratio. Efficiency ratio includes 4 ratios, which is earning per share, return on asset, return on capital employed, and return on equity. First, earnings per share (EPS). From the calculation, we can note that for every one ordinary shareholders of Aeon has earned 7.78 cents of income, while the shareholders Mr. DIY has earned 5.06 cents of income. In these comparisons, both companies have a sign of better earnings and a strong financial positions because there is only 2 cents gap between Aeon and Mr. DIY. So I believe Mr. DIY is a reliable company to invest in. Next, ROCE. For return on capital employed, the calculation shows the Aeon will get only RM 0.1887 return of annually for average for every RM1 compared to Mr. DIY. The average annual return of RM0.5256 for each RM1 of Mr. DIY investment funds. Hence, Mr. DIY has a higher percentage of ROCE of the company's value, which can ultimately be returned as profit to us. Return on asset from both calculation managements of the Aeon will be get a return of RM0.0167 for every RM1 of assets that firm invests into this company. Meanwhile, the management of Mr. DIY will generate RM0.1741 for every RM1 of asset that firm invests in. So, Mr. DIY also is higher than Aeon. I can conclude that Mr. DIY is better because the company is earning more money on less investment. Lastly, ROE, return on equity. From calculation, Mr. DIY will be able to get a return of RM0.9327 for each RM1 they have invested into the company. For Aeon, if the shareholders invested RM1, they will only get RM0.0645. As a result, Mr. DIY has a higher ROE rather than Aeon. A higher ROE indicates that the management of Mr. DIY is more effective to use investment fund to expand their companies. For market ratios are used to identify stock that may be overvalued, undervalued, and priced fairly. Market ratio includes two ratios, which are price earnings ratio and market to book ratio. Firstly, let me explain the PE ratio. Mr. DIY's calculation has a huge gap and quite a high margin, which is Mr. DIY's share currently sold for 49 times of its earning. This means the investors are willing to pay 49 ringgit for RM1 of its earning. Compared to Aeon, its shares currently sell 18.25 times of its earnings, which means investors are willing to pay only 18 ringgit 25 cents for RM1 of its earning. As a result, a higher PE ratio indicates that Mr. DIY stock is overvalued, so that we are expecting higher earnings growth in the future compared to Aeon. Lastly, a market to book ratio. A market to book ratio above 1 means that the company's stock is overvalued or the company has performed well. So, it is considered good if the ratio is more than 1. But unfortunately, both Aeon and Mr. DIY show market to book ratios that are lower than 1, which is 0.59 and 0.014 respectively. This means both companies have the stock companies are undervalued, but it is okay since Mr. DIY earning per share is reasonably.
For SWOT analysis, it will help us to analyze the progress, address what lacking, and find ways to minimize the risk. So from here, we will talk on the strengths, weaknesses, opportunities, and threats for both companies. So let me talk on the strengths for both companies. Aeon has a strong brand name and portfolio, and also has pricing power, which is the customer will come to buy their products. They also have a high level satisfaction of customers and super performance in new market. For Mr. DIY, they have good specification in production and also have special different characteristic of a brand team. They also have a high level of customer satisfaction and easily can be accessible in physical and virtual sales. We identify the weaknesses for both companies. For Aeon, we address that financial planning is not be done efficiently. The demand exceeds the technology invested, and they are not highly successful integrating firm with a different work culture. For Mr. DIY, the team in providing a quality product at a low price expose them for a high risk. They also have less variety of services and product, and also lack of expert manpower and research in production. Other than that, the demand for their products is seasonal, and it will affect their sales. For opportunities, both companies have chance to actively participate and involve in the online market to grab a new customer. For Aeon, they also can diverse their portfolio of product and services. They also can involve in production in another product field, maybe for example in the healthcare research. the market development will increase and competitiveness compared to the other companies. For Mr. DIY, they can expand from Mr. DIY outlet to Mr. DIY mall to increase their revenue. Other than that, they also can enhance business policy by producing eco-friendly products and also can expand target to international market that have same interest, maybe for example, Japan and Korea. The threat for both company, Aeon are exposed to lawsuit in various markets and also the imitation of the product on Aeon's brand. Other than that, Aeon is already international market, so it's exposed to the threat from the currency fluctuation, which is caused by the political climate across the world. For Mr. DIY, the rises of competitors in retail market become a threat for them, and it affects their revenue. The other threat for Mr. DIY is the shortage of expert manpower in production, and also the portfolio of value and quality product in cheap market might be viewed obliquely by the customer in the long-term period. So they need to make further research to meet the demand of the customer.
It is the comparison of Aeon and Mr. DIY between financial ratios. Conclusion. Okay, based on the profitability ratios, we get that Mr. DIY have the larger operating profit margin and higher net profit margin. In liquidity ratios also, Mr. DIY have more advanced quick ratio which is greater than 1. It just take a shorter period to make sales and pay creditors to its supplier, while Aeon have efficient when gathering the revenue from customer. Based on the leverage ratio, we know that Mr. DIY have the higher interest cover ratio, higher ROCE, ROA, and ROE, while Aeon have the higher EPS, which means better earnings profit. Lastly, based on the market ratios, we know that Mr. DIY have the higher PE, which is greater stock of it overvalued. Its mean expect to get higher earning growth, while Aeon created more value for its shareholders. Based on the calculation, the ability of the company to further grow and be more efficient in terms of generating future return that we choose is Mr. DIY. It is because company's value can ultimately be returned as profit to stockholders, and secondly, we can earning more money on less investment, and thirdly, management team of Mr. DIY is more effective to use investment funds to expand their company. And our suggestion to the board of directors, which company have to choose is Mr. DIY. That's all. Thank you.
Thank you, Fatin. So from this discussion, we decided to choose Mr. DIY as our investment company because they have a great and better portfolio to offer, and I hope we gain profit from this investment. So thank you for cooperating in this presentation, and it's already 5 p.m. So let me wrap up our meeting today. Thank you again for this great participation. That's all from us. Thank you.
Thank you.
Thank you.
Thank you.